Hi everyone, can you hear me?
Hi, we're audible, yes.
Yeah. All right, guys. All right. Thank you for joining. I am just waiting for few of the students who are joining since this is the first class. Okay, so let's wait for 2 more minutes and then we'll start. Okay. So today is your first class of your basically market risk. Let's talk about few stuff, few simple yet important things of exam. See, FRM part two is very theoretical in nature. There's a lot of stuff to remember. Okay, and when you're preparing for FRM part 2 you have to actually study it very differently from FRM part 1, right? So when you look at FRM part 1, right, FRM part 1 is very conceptual, very theoretical again, and the focus is on your understanding of your quantitative methods, your new concepts which are related to maybe your products which are derivatives, your futures, your option, your exotic products, your insurances, your introduction of some kind of models, right? But when you go to FRM part 2, right, the whole picture changes, right? Why I say whole picture changes, because in FRM part 2 you are more focused towards understanding of practical aspects, right? So I always see, I have been teaching for many years, right? Regarding my background, I have myself done your FRM. I did my CFA first, long back in 2000, early 2010, 10, 11, 12. Then I did my FRM. Then I did my CQF. Then I went to IIM Ahmedabad. Then I went to Goldman. Then I went to HSBC, right? So different companies, different work, asset management, strategy, etc. Right now, I have my own company. I'm running my own company, and I do teaching and all that stuff also, just to you know not be away from the finance world, right? So it keeps you in touch. By teaching it again and again, you actually are sharpening yourself. So for me it is more about that reason. But anyways, coming back to the exam perspective, I would say that I've been teaching for many years, right? So the whole idea here is that I always tell students when they are preparing for FRM part 2 that please, you have to understand that you don't have to study FRM part 2 in the same way as FRM part 1. FRM part 1 is more about, okay, they want you to introduce the risk management world. FRM part 2 totally changes or flips. FRM part 2 is all about you try to understand that what is happening in the real world, right? When I say what is happening in the real world, the discussion in FRM part 2 is about reality. Reality means they'll talk about different models. Then they'll talk about, oh, we are using this model, but this model has this problem, right? Then they will talk about, okay, this model can be used in this particular case, but then you will face this problem. So FRM part 2 is more about you read a model, you find out this is the good point of this model, this is the bad point of this model, and in reality when we use this model then this problem come. So to overcome this problem we do this stuff, right? Are you getting the point? So FRM part 2 is more about application based. FRM part 1 is more about theory based, right? So you should have a very clear right uh, distinction, right? Right, clear distinction, right? So just a second, Pratik is messaging, right? So FRM part 2, right? So I give a very crude example which some people don't like it, but I always say that, see, FRM part 1 is like a teaching in the classroom where you are taught on a uh, you know what you say, that board, right? That blackboard, right? FRM part 1 is that. FRM part 2, right? FRM part 2 is different. FRN part 2 is not like your classroom board or something, right? FRN part 2 is like, think of it like a practical thing, right? So think of it like a, you are, let's say you are a fresh civil engineer or you're a fresh mechanical engineer, right? So you learn about all that stuff in your college, now that what is the pressure, what is your torque, etc., right? Whatever. But actually when you go on ground, right, when you go inside a factory, then you learn that, okay, how this machine works, right? That kind of thing. So FRM part 2 is about learning how that machine is working, right? The FRM part 2 is more about you think about it in a very practical way. You see a certain stuff, then you look at, okay, this stuff works in this way. Then you look at, okay, is it working correctly? Then if it is working correctly, why it is working correctly? If it is not right, uh, if it is not working, just hold on for a second, guys. Just hold on for a second, right? Okay, so when you look at your FRM part 2, FRM part 2 is more about your understanding about real and practical stuff. You look at things from the perspective of reality. You look at that, okay, fine, this is a particular model, is it working fine or not? If it is working fine, why it is working fine? If it is not working fine, what are the issues? If it is not working fine, how can I resolve that issue? uh, in resolving this issue, what are the steps I'll take? If this is not working fine, do I have an alternate model? If I have an alternate model, where it can be used, where it cannot be used. So FRM part 2 is all about that practical aspect. FRM 1 was theory. So earlier you understand, right? Since this is our first class, I want to just categorically make it very clear. Earlier, a student understand this fact that FRM part 2 is all about practical aspects, and practical aspects, you don't you look at practical stuff, right? So you look at step by step. Okay, this step happens, then next step happens, then next step happens. So it is more about that remembering of next step, next step, next step, right? And I know somebody will cross question it, or somebody will say that, oh sir, this is so boring stuff, like, but this is the reality, right? This is the reality. And somebody will say that maybe this is not the best way to learn, right? I would say that maybe, right, maybe this is not the best way to learn, but at least the objective of the exam is very clear. Objective of the exam FRM part 2 is to make you job ready. And when they're thinking of making you job ready, they are thinking of making you prepare like a factory worker. Like factory worker, when he goes to a factory, right, he knows now how each factory works. So you also think of yourself as a factory worker, right? You are going into a factory and you are learning that, okay, this is first factory, this is first machine, this machine work is to whatever produce this. So you are like this only, that you are entering a factory and you're seeing the first machine. You're saying, okay, this machine is working on market risk model, this machine does these 5 steps. In this 5 step, I after that 5 steps I get this thing. So that's how you have to learn. So you have to, like, my point here is, earlier you make peace with this fact, better it would be for you, right? Because otherwise it's always a thing that what exactly FRM part 2 is, why it is so irritating, right? Because it will be irritating. You have to remember a lot of stuff, right? A lot of stuff. We will give you the notes, you will get the notes, I'll teach you in class, I explain the thing. But if you have remember, let's say 100 things, or let's say you remember 500 things in FRM part 1, FRM part 2 you might have to remember 1500 things. It is almost 1.5 times bigger, and concepts are more, formulas are more, and there are a lot of small points. Okay. All right, guys. Let's start today's topic. We'll keep on discussing these things as we progress ahead. Today was, just I was waiting for others to join, so I wanted to give you this perspective. But let's start now. I think it's already 15 minutes. We should start. Okay. So today is the first topic. The first topic of what? Book number 1. Right. Book number 1 is what? Market risk. Right. And the first topic is estimating your market risk measures. Now, if you remember your FRM part 1, you all know what are measures, right? Risk measures, right? What are risk measures? There was a chapter, in the book 4, there was a chapter called risk measures. What were different risk measures? Your standard deviation is a risk measure. Your VaR is a risk measure. Value at risk is a risk measure. Expected shortfall, which is also known as your conditional VaR, is a risk measure, right? So you studied these all risk measure. In fact, you studied what all? You studied also what? there is special thing called coherent risk measures. And then what did you try to understand? You try to understand the coherency of risk measure. What were the 4 properties for coherency of risk measure? Anybody remembers? Just checking, guys. Anybody remembers what are the 4 properties?
Subjectivity, monotonicity, translation variance, and
One more, right?
fourth
Right.
one. Yeah,
So
fourth one.
positive homogeneity, translation invariance, subadditivity, and which one was that? Monotonicity, right? Monotonicity, right? The 4 properties for a coherency of risk measure, right? So you understand, you have studied all these things. So this chapter is the first chapter, mostly theoretical in nature. Lot of recap. So it's the first day. We'll not take very hard stuff, but we'll slowly try to take it to the next level, right? So first day, it is divided into 2 parts. One is your module 1. We'll talk about your historical and parametric estimation approaches. Any thing strikes your mind when you talk about your parametric thing? What do you mean by parametric? Parametric, right? Delta normal approach, right? Delta normal approach was parametric approach. Parametric approach is something which has parameters, parameterized. Parameterized is what? Which has formulas. Formula is what? Delta normal approach. Delta normal calculation of VaR. Delta normal approach. Remember the formula? Anybody know? You have forgotten. Mu plus Z sigma, right? Mu plus Z sigma, right? We'll see all that stuff here, right? So parametric approach, parameterized approach is based on your formulas. Historical approach is not based on formula. Historical approach is based on historical data. Do we have your any what you say? Do we have any distribution for historical approach? No, we don't have. It's quite flexible in nature. Whatever is available, we'll take it. But when we take parametric estimation approach, what we try to do? We try to have your assumption about the distribution. We try to have the assumption. We try to have an assumption before we move ahead. We try to say, that, okay, let's assume that the returns follow a normal distribution. Let's assume the returns follow a log normal distribution. So before we put a formula, we do the assumption, right? Because if you don't do the assumption, we cannot move ahead, right? Parametric estimation is all based on assumption, right? So we have to first do the assumption, right? And then we'll talk about the risk measures and their properties, etc. So it's a very easy, casual kind of first chapter where most of the things will be repeated what you studied in FRM part 1, but that's not what FRM part 2 is. This is the first chapter, so it's easy. Next chapter onward, things will become difficult, definitely. Okay, let's get started, guys. Let's move ahead. First day, take it easy, right? So this module is further subdivided into 8 topics. We'll talk about estimation of return, the key concept. We'll talk about your historical simulation approach to VaR. Historical simulation approach, right? Simulation is what? You simulate the values, right? Then examples of VaR limit and VaR estimation. Then we'll talk about your parametric estimation approaches. Parametric, I told you, it is your using the formula. Then we'll talk about parametric VaR, which is normal VaR, and their overview. Then examples of that. Then log normal VaR. See, log normal VaR, this part you haven't seen earlier, right? So the second part, in fact, the topic number 7, you have not seen earlier. In your FRM part 1, you have seen only normal VaR. You have not seen log normal VaR, right? Log normal VaR was not given in FRM part 1, right? You have not seen this part, right? So this will be new to you, right? These 2 things will be new to you. Rest you have already done. This you have done. This you have done. All these things are just a casual kind of repetition, but we'll see, right? We'll discuss. This is a good recap. Okay. First, try to understand the estimation of return concept. When you talk about return, see, there are 2 kinds of return in financial world. One is your arithmetic return, another is your geometric return. Arithmetic return is your simple return, right? Geometric return sounds very fancy, but it is basically your continuously compounded return, right? So continuously compounded and your arithmetic return you have learned in your FRM part 1. You understand what is that. What I want you to understand is that the convention in the risk management is that always remember that you quote your return losses as positive value for clarity. So when I say a loss of 1 million would be stated a loss of 1 million, not a profit of minus 1 million, right? So that's a convention. So conventions we have to remember. And then when we take the profit loss data, since you will see some question as, they will give you profit loss data and profit loss distribution, please understand that we might get data in the profit loss data format, we might get data in the arithmetic return format, we might get data in the geometric return format. So whatever way the data is given, right, we should be able to convert that, right? That's the only objective. If we have been given data in a particular format, we should know how do we convert the data from one form to another and calculate the VaR or whatever risk measure we have to calculate, right? That's the whole objective. So three kind of data which exist normally. You will see one is the profit loss data. You will see which is the most direct way to measure. You will see profit and loss, and it represents the change in the value of an asset or portfolio from one period to the next. And then you have any interim payments like dividend interest will calculate. So what is happening here? I think it is pretty straightforward. You all know that when in your profit and loss data, what is happening? You have today's value, today's price minus yesterday's price, PT minus PT minus 1, and then any dividend, etc., which has come in the time, right? That's a profit and loss data. When you go to arithmetic returns, your simple returns, then small r, then here you are doing PT again minus PT minus 1, and then you are doing DT, right? But you are taking arithmetic return, so you're taking the value corresponding from the previous value. And then when you're going to geometric return is your continuously compounded, right? And it's also called your kind of log normal kind of thing, right? So here you have RT is equal to natural log PT plus DT divided by your PD minus 1, right? So you take the log of the full thing, right? Log of the full thing. Don't forget that. It's not log of the only numerator. It's log of the full thing, right? So these are three formulas you need to keep in mind. I don't think they will ask you a question on any calculation of formula, but more importantly, the objective here is to make you understand that the data might be presented in different formats. And if data might be presented in different formats, you should be able to calculate the value of your VaR or any corresponding risk measure by using any of the formulas which are given, right? So objective is very straightforward. I think you already reach FRM part 2 level, so you guys are quite smart enough to understand that where exactly the syllabus focuses on, right? So that's one thing. If you have any question, guys, please keep asking. Don't kind of hesitate. Okay. Then it is about historical simulation approach, right? Historical simulation. Simulation is the keyword here, guys. Historical simulation, right? Simulation is you are simulating the values, right? What are you doing here? You get certain values, you simulation certain values. Now, how do you calculate the VaR with that? Very easy, right? You order, let's say you have 1,000 values, right? 1,000 values, you order, right? First order means you have a systematic kind of representation, and then once you have systematic kind of representation, you take it from the top to bottom, right? Generally you will put the heaviest lost on top and their profit you're on bottom, right? And you arrange it, right? You arrange from top to bottom, right? And then once you have arranged from top to bottom, let's say at the 1,000 observation, I'm trying to find your fifth value, right? 5% value. This you have done in FRM part 1, right? So what will happen? So basically the 50th observation which I'll receive, right? That is my 95% VaR, right? So it is that line which is distinguishing, right? Same thing. N is equal to 1, 95% confidence. Lower tail, lowest 5% of return, 95% confidence. Lowest 5% return, 95%, 95% your confidence level. VaR is minus 15.5%. So minus 15.5% is why? Because this is minus 15.5%, right? Even though it is not very clear, but I just want to tell you, right? And for $1 million, what are you doing? You're multiplying minus 15.5%, multiplying by the notional principal, right? 1 million, right? Which is giving me minus 155,000, right? So this is my calculation of my VaR under the historical simulation approach. What is important to understand here is that what are you doing? You are arranging the data. Don't forget this term. You have to order the return observation. That is very, very important, right? And when we see historical simulation approach, right, it seems like a wonderful method because we are using a historical simulation approach. But the problem here is that we are putting a condition here that the future, right? Future is dependent on your past, right? Because we are here using historical simulation. When I'm using historical simulation, what is important to understand is that once you do simulation, inadvertently you are assuming that your future is like your past, which might not be true, right? If you are assuming your future returns follow same percentage as past, this is not a very sound observation, because future can be many, like, much different, right? And you cannot adjust for changing economic conditions. Sometimes the conditions change very fast, right? The advent or the pace of change of your uh, future sometimes is very fast than your past, right? So, and then unable to accommodate your abrupt parameter shift. That's what abrupt parameter shift, sudden changes, you can't do that. So these are the few of the key things which come in historical simulation approach. There are certain advantages, but there are certain disadvantages also. Moving on, guys. Next is example of your VaR limit and VaR estimation, right? When you talk about your VaR limit and VaR estimation, again, the same example I have taken, VaR to be estimated at 95% confidence, right? Here, you take 50 of the ordered observation would fall in the tail of the distribution. Therefore, the 51st order loss observation would separate the 5% of larger losses from the remaining 95% of return. And when you're trying to compute your VaR, this is the VaR limit, guys. That limit is at 51, right? When you're computing the VaR, a long history of profit loss data closely approximate a standard norm distribution that we have seen in the properties of FRM part 1. In FRM part 1, what did we see? In FRM part 1, we saw now that if there is any observation and when we have law of large numbers, right, it kind of corresponds to your standard normal distribution, right? So that's what we get. So we estimate the 5% VaR using the historical simulation approach. So that also can be done, right? And when you look at the solution part, the VaR limit will be at the observation that separates the tail loss with area equal to 5% from the remainder of the distribution, that we understand. See, ultimately, this all you have seen in FRM part 1, right? What was done in FRM part 1? You used to take this distinction, that this is your 95% cutoff, right? So we used to take, now if we have to take one tail, right, what is the value we used to take? 1.645, right, or 1.65, right? This is the value we used to take Z table, right, from Z table, and we used to take this value for critical value for your 95% confidence level, right? So this is for one tail, guys. Please understand, this value is for one tail, because VaR is one tail. VaR only focuses on your losses, right? So otherwise, we all know that, right? 1.645 is for 90%, right? But here, since 90% of two tail is equal to 95% of one tail, right? So we are taking it 95% value, so that we get the losses only, right? So that's how you calculate. That's why VaR is 1.65, 5% critical value from the Z table. Recall that since VaR is a one tail test, I told you same thing. The entire significance level of 5% is the left tail of the return distribution, right? So again, I don't think anything here which has been discussed is new concept. You have seen everything here in your FRM part 1. So now we're just revising it. Okay, let's try to do this question, guys. The VaR at a 95% confidence level is estimated to be 1.56 from a historical simulation of 1,000 observation. Which of the following statement is most likely to be true? Now, you guys help me. I know the answer and I know how to solve it. But take a shot, guys. See, this is not a new chapter. I just want to see if you guys can answer it or not. Anyone want to kind of answer it or want to take a try, make a try, right? See, what it is saying is 95% confidence level. The estimated, value is 1.56 from a historical simulation. Now, for 1,000 characteristic, right? Observations, right? Which of the following statement is most likely true? Okay, let me make it easier. See, generally, right? I am talking about normal distribution. Normal distribution, if I make this distribution, this value which was cut off for 95%, right? So 95% data here, 5% data here in the tail, right? In the tail, you have 5%. And we are bothered about tail only, right? Because we are looking at your loss, right? If we are looking at your loss, right, this part, right, let's say we are looking at this part, loss 5%. Now when you're looking at this part 5%, now what is the point here? Sorry, this pen will not work here. So basically the value, generally I told you right now, this value is 1.645 minus 1.645, or you can approximate it 1.65. So 95% data on the other side, 5% in the tail, right? And the value this. Now, this is a normal observation. Now, in historical simulation, what it's saying is that we have similar kind of thing, right? Similar kind of thing. Here it is said that 95% data, again 95%, right, is at 1.56, right? Minus 1.56. So what are you seeing? So in other way, if I make both in same place, this point is your minus 1.56. Obviously, it will come before 1.645 because this is the zero. Now it starts from zero, right? Center point is zero. So if your maximum data, like what I'm trying to say, in normal observation, till red line is 95% data. In historical simulation, till this brown line, we have 95% data. Now you tell me if this brown line, covers 95% data till here, and if I move this brown line, just think of it. If I move this brown, so this brown line is covering 95. If I move this line to brown line to red line, will my coverage of data increase or decrease? If I move this,
Increase.
increase, right? So if it will increase, so maybe it will become 96%. Let's say it will become 96%. So if my data, if it moves to this red line, brown line moves to red line, my coverage will 96%. So what will be my value in tails in that case? Will it be 5% or what it will be?
4.
4%, right? So what has happened in the tail, right? What has happened? Tails have become thinner or fatter?
Thinner.
Thinner, right? So tails are becoming thinner, na? So which is the answer here? The historical distribution has thinner tails, right? Thinner tails than a normal distribution, right? So again, not like this is not a new concept. It is just taking your previous understanding. The whole idea here is that when the thing has moved ahead, it's a thinner tail, right? So parametric assumption of normal return is correct, right? We're not talking about that. Parametric assumption of log normal return is correct. We're not talking about that. Historical distribution of fatter tails, absolutely wrong. Right? These are inconsequential. So answer is this, right? D. And I gave you the logic also, right? So not very difficult, but yeah, it's checking your understanding, right? Moving on, so this is what we have. The historical simulation indicates that the 5% tail loss begins at 1.56, which is less than 1.65 predicted by a standard normal distribution. Therefore, the historical simulation has thinner tails than a standard normal distribution. All right, so let's move ahead, right? Then we move into next question, right? Very interesting question. Again, this is very interesting question, right? To be fair, assume the profit loss distribution or XYZ is normally distributed with an annual mean of $20 million and a standard deviation of $10 million. The 5% VaR calculated and interpreted by as which of the following statement? First, you tell me, anybody remembers what was the simple value or simple formula for calculating VaR? Anybody remembers delta normal approach? Mu
Yeah.
plus
Plus
Z sigma.
minus Z. Yeah.
Z sigma, right? So again, this question little bit confuses people, but uh, the solution which is given for this question is actually taken from Schwezer, right? So solution is right. I'm not denying it, right? Which you'll see ahead also. But I'm trying to give you a fact that I have a better hack here. So I'll tell you a hack here is that see, profit loss is given, profit loss distribution. I told you very clearly when I was teaching you theory that you will get data in different ways, right? So you are getting data, if you see here, Right now you are getting this data, profit loss data, the first type of data. Right, ahead you will get arithmetic return also and geometric return also, right? So don't worry about it. Now what I'm trying to say is, when you are getting a profit loss data, right? So when you talk about a profit loss data, right, what is important to understand is that since the value has been given 20 million, see, mean has been given positive, means it's a profit. So with the profit, I'll put 20 here. Now the question comes Z. See, Z is the value, since I am focusing on 5% VaR. So Z value will be minus 1.65. So it is minus 1.65 into your sigma. Sigma is 10. So when you solve it, 20 minus 16.5, which is 3.5. Now, since this is positive value, if I get positive value, it is earnings. If I would have got negative value, if I would have got negative value, it would have been your loss. Okay. So the whole idea here is that what value you're getting. Why I'm using this formula? See, when you will see this question result in Schwezer or next slide also, you will see something else. But I don't use that method generally because maybe I love this simple method. If I get positive value, it is earnings. I get negative value, it is loss. So I don't want to make my life complicated. So I keep it very easy. I think Schwezer makes it a little difficult, right? So you want to follow my method, you're welcome, right? My method is very straightforward. Take the, if it is profit, take mu positive, Z 1.65 negative, sigma directly, find this. If it is positive, it is earning, negative, it is a loss, right? Very straightforward, very easy method. So it is positive, it is earnings, right? So it is earnings, if not losses, right? And then it is, since we have taken 5% work, is calculated interpreted at what? It's a 95% probability of earning of at least, right, 3.5 million. So that's what the definition of VaR is. It's not the 5% probability, right? 95% probability, you already know that, right? So it's very straightforward, right? Very, very straightforward. Now when you go to the solution of this slide, there nothing wrong, right? They have also on their own method, but I don't follow this method because my method gives me very intuitive understanding, but this method is also not wrong. What are they doing here is that they are starting with minus 20. What they are doing is they're taking minus mu, right, plus z sigma, right? So here they are actually starting with a negative value, right? Right. So this is the method they use. But again, you have to then remember sign, etc. Also, I don't remember that much. And then you solve it, minus 20 plus your 1.65 into 10, and so you get minus 3.5. Then you say that okay, minus means it is opposite to your losses, so it is earning. So here they create a confusion that okay, you have taken minus. So what these guys say in this method, they say that if you are getting a positive value, right, if you're getting positive value, that is a loss. If you're getting a negative value, that's a profit. So these guys assume like this. I don't like this method personally. I don't like this method at all. I say that okay, let's not confuse it. Let's keep it very simple, like normal stuff, right? I keep it very simple. I keep it your simple method, which is mu plus z sigma. I say if it is profit, I say profit is positive, loss is negative. Right here they say profit, positive is loss and negative is profit, right? So choose whatever you want to choose. My method is this one. If I'm getting a profit 20, z is minus 1.65, right, and you are taking into your sigma is your 10, right? So my value is coming like this, 3.5, right? So I take it 3.5, it is earnings. They take it that minus 3.5, since it is coming negative, so it is earnings. So both answers are same, but interpretation is different, right? This is, I'm not saying this is wrong method. This is also correct method, but I get confused here, and you guys choose whatever you want to choose. I will prefer that you will choose this method because this is very intuitive to understand, right? But these guys have a different way because they want to say that, oh no, let's take the 1.65 always positive value because we are taking losses always, right? So again, confusion, but remember whatever you want to do. Ideally, prefer, remember this method. This is very easy, which I use. Okay, so this is done. Then we talk about your parametric estimation approaches. When I talk about parametric estimation approaches, see, parametric, I told you very clearly. Parametric is parameterized. Parameterized means your something which has parameters. When I say parameters, what do I mean? Something which has formulas. Parametric means formulas, parameters, right? Parameterized, right? Formulas. The parametric approach, delta normal approach, you have seen already, which I told you, mu plus z sigma, right? That is one, and explicitly assumes a distribution for the underlying observation. Now there are two kinds of distribution in your syllabus in FRM part 2. One is VaR for returns that follow a normal distribution. This you have seen in FRM part 1 also. So this should be a piece of cake, right? FRM part 1. This is new for you. FRM, this is FRM part 2 only because this you have not seen in FRM part 1, right? So this should be new to you. But again, the formula is quite easy, right? Again, the point here is if I am taking your arithmetic kind of, uh, basically when I go to returns, right? Returns, there are two kinds of return: arithmetic and your geometric, right? Arithmetic returns, and I have to calculate VaR in that case. Arithmetic, so there's a different formula. Geometric, there's a different formula. I'll tell you ahead, but just wanted to clarify here, right? So, and then we have normal and log normal distribution also on same lines. Okay. Okay, let's move ahead. Okay, I think this has come already, right? So again, don't lose the bigger picture. Bigger picture, I'm telling you why I'm telling you don't lose the bigger picture, because I'm telling you very clearly that why are we learning all this? We are learning all this because the data is different, right? The type of data is different. Now, what can I do, right? If I get a different kind of data, I have to know how to solve it, right? If I get a profit and loss data, I know how to solve it. If I get arithmetic return data, I should know how to solve it. If I get a geometric return data, I should know how to solve it, right? I cannot say that, oh, I only know profit and loss data, I don't know how to solve arithmetic return data. No, you have to know how to solve it, right? That's the basic essence, right, of all this understanding, right? Keep that in mind very, very clearly that you need to understand how to solve it, right? If you understand how to solve it, then it's perfectly fine, right? So that's what we have. And if I go ahead now, so this chapter is easy, guys. A lot of concepts are very straightforward, simple, easy, what you have studied, right? So moving ahead, where were we? Yeah, so we were doing this part. So in this part, if you see, so conceptual understanding, I don't think anybody here will not be knowing VaR separates your tail losses, right? Ultimate objective of VaR was this only, right? To separate the tail losses from your remaining distribution at a given confidence level. VaR cutoff located in left tail of return distribution, that we understand. Calculated value is negative but reported as positive, right? Negative amount implied for profit and loss data, which we saw, right? VaR value was this, right? This is the formula given to you, right? Which the book was also following. This is minus mu. The formula was your minus mu plus your sigma into z. I don't like this method. I prefer my own sweet method, mu plus z sigma, where I take z value as negative and solve it. But again, choice is your, use it or use it, right? Whatever you want to use, right? Mu is obviously your return, sigma is obviously your volatility, z is your z value, right? Z denotes the critical value quantile of the standard normal distribution. In practice, the population parameter mu and z are not likely known, so that we know already. For any population, it's not easy to calculate. So what we'll do, we'll take the sample mean, a standard deviation, whatever. Now I'm telling you arithmetic mean. So what you see the point here. Now we are getting into arithmetic mean, right? I told you very clearly that data could be profit and loss, data could be arithmetic. Now in arithmetic routine, again I'm doing the same stuff, right? Again I'm doing the same stuff, right? Mm, I am doing mu plus z sigma. This is my style, mu plus z sigma. You have to multiply by your previous value, right? Previous value, mu plus z sigma, previous value. Okay. Again, this is my style. If you want to follow book style is minus mu plus your z sigma into your pt minus 1, right? Whatever you want, whatever style you want, you follow. I prefer this because it is very intuitive for me to answer and think. I don't have to remember anything what is plus minus. Okay, so this is what it is done here. We can solve the numerical, you will understand, right? Assume that the profit and loss distribution for a xyz uh, xyz is normally distributed with an annual mean of your 15 million. So mu is equal to your 15, right? Standard deviation sigma is equal to your 10, right? Calculate the VaR at the 95% and 99% using a parametric approach, right? So we are trying to find out profit and loss distribution, right? Please understand it's a distribution profit and loss. So it is very simple. Mu plus z sigma for me. Mu is 15, z is plus minus 1.95% minus 1.65 into sigma was 10. Right, straightforward. It is, you calculated, right? The value came out 15 minus 16.5 minus 1.5. This pen is not working here, so we have to change the pen, right? It is your minus 1.5 is 16.5, 15 minus 16.5, that is 1.5. But I know it is negative sign, it's a loss, right? So expect to lose more than, 1 point, right, with a 5% probability, 95% at most 1.5 million over the next year with a 95% confidence, right? Then we have 1%. 1% again, same logic. Your mu is your 15, sigma equal 10, and then you take what? You take again 15 value minus your 2.33 now into your what? Into your 10, right? So you take it that way. So it is 23.3, which makes it minus 8.3, which is a loss. So you say that at most I can lose 8.3 million, right? 8.3 million, which is greater than VaR at 95, right? So this is what we do. Okay. So this is your profit and loss, guys. Pretty straightforward. Now, when I get into your arithmetic return, right? Arithmetic return, not the compounded arithmetic return, right? Computing your arithmetic return, right? Only difference which is happening is that I am still using the same formula. I'm using the mu plus z sigma into your what? pt minus 1. That's what I'm doing. If I'm doing that, what is the answer here? So answer here is again mu. You don't take negative value. Return is, I don't take, mean is positive, so I take 10%. Z is your 95%, so you take 1.65, but you take the negative sign, right? I take a negative sign, and you take sigma. Sigma is what? Sigma is 20%, right? And you multiply that with your what value? 100, right? So 10%, and you multiply with what percent, right? So it is minus 33%, right? So it is into 100, so it is minus 23% into 100. So minus 23 value, minus 23 means it's a loss of 23. So VaR is loss of 23, right? So again, different ways to solve it. Same thing here also, you can solve it, right? My point here is that, I love a particular method. I don't like Schweizer's method, which makes me think too hard. I like simple method. You want to follow simple method, you follow my method, right? But both are correct, right? Nothing wrong. Now, next is your log normal distribution properties. Log normal you already know, right? Log normal was what? Log normal was this, na? Log normal distribution. You start from zero, you're skewed to the right. Right skewed, bound below by zero prevents negative asset prices. This was the assumption of your prices in your Black-Scholes model also. Return of assets and prices, the formula which came out is very simple formula. Again, 1 minus exponential your mu plus z sigma, right, in bracket your pt minus 1. Again, I'm telling you, my formula is again very good, right? So the whole idea which I'm trying to tell you, if I have to find the three formulas I'm giving you, if I have to find simple profit and loss data, I love the formula mu plus z sigma. If I have to find arithmetic return AR, I love the formula again mu plus your z sigma, and I multiply that with your pt minus 1. If you give this part is right. If I have to do geometric return, again I use your mu plus z sigma, but I twist it. I take it exponential mu and sigma. I take 1 minus exponential mu plus z sigma, and I take pt minus 1. So whatever, right, whatever way I'm doing, right, whatever way I'm doing the same thing, guys, right? You follow book method, they are also doing the same thing. I am also doing the same thing. You put the values, you get the answer, right? So overall, please understand the method is not different, or we are not doing wrong things. It is just uh, I am putting z value as minus 1.65, book is putting z value as positive and other value is negative, right? So whatever way, right? Just understanding. Commonly used to prevent your modeling negative asset prices, that we understand. In your logarithmic return, VaR can be derived through algebraic manipulation of these relationships also, that also we understand. The calculation of log normal VaR, which is geometric returns, and normal VaR will be similar when we are dealing with short-term periods and practical return estimate. That value becomes similar, right? In the shorter period or in a smaller time frame, arithmetic return is almost equivalent to geometric return, because compounding doesn't happen. No? Arithmetic is a geometric return. It happens similar in your smaller time frame. Smaller time frame. Okay, so that's what we have, and then we go ahead. Let's solve the questions, right? So we have the question here: computing VaR, which is the log normal distribution. A diversified portfolio exhibits a normally distributed geometric return with mean and standard deviation of 10%. Mean, again, let's solve it. Mean, my method. My method is what? Again, mu plus z sigma, but now since it is log normal return, I take exponential, I take 1 minus exponential, and I take pt minus 1. I use it, same things every time, right? So it is 1 minus exponential, which is mu. Mu is what? Mu is 10%. So I put it 10%, right? 10% means 0.1, right? And then z value, if I have to calculate for your 5%, I know what I have to do. I have to take what? I have to take 5% value is your minus 1.65, right? Z, and sigma is what? Sigma is 20%, is 0.2, right? And the whole thing has to be multiplied by the previous price, which is 100, right? So again, you are getting the same thing: 1 minus exponential 0.1 minus, right, 1.65 into 0.2 is your 1.65 into 0.2 is 0.33, right? 0.33, right? And into your 100. So if you solve this, this comes out 1 minus exponential 0.23 negative, right? And into 100. So both ways you are getting the same answer. Either you follow book method, either you follow my method. I love it because for me it is pretty straightforward. If I am taking arithmetic return, geometric return, profit and loss, it is always mu plus z sigma, mu plus z sigma into pt minus 1. Or geometric return is also mu plus z sigma. Only thing is exponential here, 1 minus, you take like this, and you take pt minus 1. Right? Whatever way you do, you always follow a simple, straightforward method. Choose anything, guys, but whatever method you choose, understand how it is used, right? So very straightforward. Okay. So this is done, guys. Let's see. We have, okay, fine. So we have completed the module 1, guys. Anybody any doubt can ask me before I move to module 2, right? See, this is our first class. We have to adjust to each other. So I would like to take a feedback. Am I going too fast? Am I going to going too slow? Or or is the pace fine, right? You can let me know. How's it?
It's fine.
It's fine, right? Okay, great. What about others? Okay.
Yes, yes, it's fine.
Right. So this is our first class, guys. So we are taking easy stuff. See, I'm giving you two approaches. Don't think that I'm trying to confuse you, right? I'll be very honest here. See, certain times, book makes things unnecessarily difficult, right? And then you think that, okay, why it is making life so difficult? This is very intuitive and understanding, right? So that is what I am telling you, right? It is very intuitive and kind of thing, right? Why a book is using minus sign, and why it is taking the all that drama, right? You think of simple way, it's mu plus z sigma, right? Just put z is equal to minus 1.65 whatever, right? And find out if it's negative value, it's a loss, positive value, it's a earning. It's very intuitive, like a school student, right, kind of approach. So I love that kind of thing, because then it doesn't put pressure on my mind to remember anything. Otherwise, if you take difficult approach, then it is a pressure that you have to remember smaller points. If you then you are trying to, because our mind is also like a computer, right? It's you have to free your space, like you cannot occupy your mind with unnecessary stuff, because then how will you add more stuff, right? So you want to keep your memory clean, so that you can remember difficult stuff later. So I'm trying to put that clean kind of stuff there, that keep your memory clean, so that later on when you have to remember difficult stuff, then you have space in your hard drive, right? Otherwise your hard drive is already full, then how will you remember stuff, right? That's the point. Okay, anyways guys, we have done till here. So that's how we progress. Normally we have done module 1, right? We have 2 modules. So if you go back, I think one student has joined late. So we had 2 modules here, guys: historical simulation approach and parameter estimation, right? We have done this module. Right now we'll take a break, small break, and then we'll take second module, your risk measure. And see, the hallmark of FRM part 2 in GitHub is that uh, notes are good, right? See, I am making the slides dirty, but you will get both kind of slide. You will get the clean slides also. You can get a dirty slide also, right? So you want to print out or whatever, you want to take a screenshot, you can take that, and you will get my this dirty slide also. So to see the notes, right? So whatever way you will get the slides. So we don't waste time in unnecessary writing. So that's a good part here, right? So we save time in that way. So even though we take 2 hours class, but that in 2 hours we cover almost three and a half hour stuff, because everything is already written, right? So you only have to focus on understanding that part with a tutor, right? So things become faster to grasp, right? So normally this much stuff, if I have to teach in writing way, I'll take 1.5 hours to 2 hours, right? But I don't have to write now. It's already written, right? So this is done, guys. We can take a small break, guys. 7:30 it is, so we are going fine. We can take 10 minutes break. We have the small topics on 10 minutes break. 7:40 we start again. Okay. All right, guys. Thank you. Let's start the next part. Again, chapter is quite easy, not very difficult. Why it is easy? Because this is covering your most of the things which you're studying in FRM part 1, right? So not difficult at all. Few things will trouble you, your QQ plot, etc. But otherwise, I don't think there should be any challenge in understanding this module also, right? So first chapter is easy, guys, but it's my duty to warn you that please don't expect that whole FRM is like this. So this is an easy chapter. Slowly, levels will become quite difficult, right? Quite interesting, right? If you have time, we have recorded many lectures. You can go and watch those also. You will find that FRM part 2 is quite difficult, right? But yeah, first chapter is easy, so take it, enjoy it till it lasts. So let's cover it now. So we'll in this chapter we'll talk about there's 7 subtopics. I don't think there should be any problem in topic 1, 2, 3, any issue, right? First 3 are just very casual, right? Expected shortfall overview, expected shortfall example, coherent risk measure. We discussed it before we started the class. Then monotonicity, subadditivity, translation invariance, positive homogeneity, right? Then coherent risk measures, convergence and standard error. That is a little interesting, right? And then we talk about the estimating standard error example we'll do, and then we'll talk about variance approximation for coherent risk measure, and last part will be quantile QQ plots estimation, right? So let's get started, guys. Let's try to wrap it up. Okay. So, all right. So the first part is the overview of the expected shortfall. Now, when I talk about the overview of the expected shortfall, you already know, right? You studied your standard deviation in FRM part 1. You guys studied your expected shortfall in FRM part 1. You studied your VaR in FRM part 1. You understood that VaR was very good. VaR was one of the most popular methods in your estimation of risk, but there was some problem, right? The problem was that VaR was not telling you anything about the losses, beyond a particular threshold, magnitude of losses beyond that particular threshold. They were having no idea, right? It was giving you a maximum loss at a given confidence level, but what was beyond that point, that was, no clue of the tail, right? So expected shortfall came, and expected shortfall gave you that idea of the tail. You wanted that idea of the tail, and it is called your conditional VaR, right? CVaR, conditional VaR. Okay. So expected shortfall is again type of a VaR, right? But it's a conditional VaR, CVaR, right? Estimate your average loss in the tail. So that's good, right? And compute by dividing the tail distribution into n equal slices and averaging the corresponding one. So this understand a little bit. What are we telling here? That if you want to find out your, let's say this is the distribution. If you want to find out what is the losses beyond, in this part, right? What do? You take the tail, you slice it means you divide the tail into different parts and then average it, right? So what you do is that, let's say you divide the tail, you take one division, second division, third division, right? You divide it, and then for each part, right? This part, this part, this part, this part, and let's say 5 part you do it, 5 part you do it, and you take the average of those 5 parts, right? So computed by dividing the tail distribution into n equal slices and averaging the corresponding VaRs, right? That's what you do, right? And VaR gives only the maximum loss at a given confidence level. It does not show the magnitude of losses beyond that particular threshold. Okay, it does not show beyond a particular threshold. Okay, moving on. That's it. That's what we are talking about, right? We are talking about slicing and dicing, right? Divided n into 5. So what we are telling it, same thing, right? You have taken a distribution, you have taken that, okay, tail has these many things, right? Now I am dividing it. Same thing they have done here, right? You have divided into, right? Divided the tail into parts 96, 97, 98, 99. You have divided the tail into 4 parts, and each level, the VaR value is this. What do? You took the average, right? Average of the tail losses. Average of tail losses. That's why you get 2.003, right? You divide tail split into 5 slices, compute 4 VaRs for increasing confidence level 96%, 97%, 98%, 99%. That's what you are doing, right? 1 division, 2 division, 3 division, 4 division, right? So total by 4, it makes 5 parts. 1, 2, 3, 4, 5, right? Right. So you do it, and then you calculate average of these tail VaRs gives a better picture of extreme losses, right? And we know that, right? That expected shortfall is a better way to measure your extreme losses. Please understand that VaR increases from the difference column. You see, when you move to 96 to 97, it increased. 97 to 98 increase. 98 to 99 increase. So VaR kind of increases, right? VaR increases from difference column, right, to maintain the same 1% interval mass, because the tail gets thinner with higher n. An average of 4 VaRs is 2.003, which represents the expected shortfall, which is your this value, which is your 2.003, which is this value, right? And which is basically probability weighted tail loss. As your n increases, the expected shortfall rises. We understand, right? As you go beyond extreme value, right, and converges to the true theoretical value, which is this, right? So convergence will happen, that we understand. And with large n greater than 10,000, the average of many VaR approaches the theoretical expected shortfall. Okay, so we don't need to, these are such properties we need to understand. But overall point here is that we started with what? We started with n smaller. First, we took n is equal to 5. So n is equal to 5, we are taken only 5 slices, right? 5 slices, right? If we increase n is equal to 100 slices, we will go more closer to theoretical value, right? If we increase is it n to 10,000, we will go more closer to theoretical value. So as n increases, your accuracy increases. When accuracy increases, the difference between your average and theoretical value converges. Okay, so that's the whole idea. Okay, I don't think there is any problem here you will face. Okay. All right. Next is coherent risk measure. You all know that we discussed 4 properties. One was your translation, invariance, right? You have studied this in your FRM part 1. Next is your positive, homogeneity, right? Homogeneity. Third is your subadditivity, which was for which VaR used to fail in certain times, and then it was monotonicity. Okay, these were the 4 properties of coherent risk measure, right? Uh, Definition: weighted average of loss distribution quantiles based on user specific risk aversion. Now, what is happening here? Right? See, the whole point here is that we are talking about your weighted average of loss distribution quantile, right? So, why are we talking about weighted average of loss distribution quantile? Because we are trying to distribute the return. I would say distribute. We'll try to understand the return in a much better way, right? So this method, right, weighted average of loss distribution quantile based on user specific risk aversion, right? So this method, right, this method is more general than your VaR expected shortfall. Expected shortfall is a special case. Now, what happens here is that expected shortfall uses your constant weighting, right, for your tail losses only, and your other quantiles weighted 0. I know this is little confusing, but hold on, right? See the methodology. Entire distribution divided into equal probability slices. So we studied slices now. Now entire distribution is divided into entire distribution divided into equal probability slices, not just tail region. So you're not dividing just the tail region. You are dividing the entire distribution into equal probability slices. Now each slice weighed by risk aversion. So we have taken a risk aversion function. Okay. So new concept is being discussed here. Risk aversion function. So entire distribution is divided into equal probability slices. Each slice is weighed by a risk aversion function, and then we do the averaging. Okay, so it's a different method. It's a different methods. This method is more general than your VaR expected shortfall. Expected shortfall is a special case of this method. Expected shortfall uses a constant weighing. What is the constant weighing they are using? Which is 1 divided by 1 minus confidence level. Now, a lot of you will think of it that's this we have not seen earlier. Yes, this we have not seen earlier. This is a new method which is being introduced here. What we are saying here is that if we want a coherent risk measure, we can use a see in FRM part 1, we have seen that expected shortfall was a coherent risk measure. Now here in FRM part 2, we are saying that okay, fine, expected shortfall is a coherent risk measure, but then we are also saying that we have a more general form, and in that general form expected shortfall is one of the case, right? So we are saying that expected shortfall is a your specific case of your coherent risk measure. In FRM part 1, you studied only one thing. Expected shortfall is a coherent risk measure. Now here we are talking about the expected shortfall is a specific case of coherent risk measure, which uses a weighing of your 1 divided by 1 minus confidence level, right? Otherwise, what do? You divide the entire distribution into equal probability slices, and each slice is weighed by risk aversion function and your kind of average. Again, you don't need to go in how it is done. Coherent risk measure, n equal 10 example. So divide the distribution. Split your return distribution into n equal probability slices, right? Why 9? Because you are dividing into n minus 1. Break down at 10, 20, 30, 40, 50, 60, 70, 80, 90, right? So entire distribution, what you are doing is dividing 10, 20, 30, 40, 50, 60, 70, 80, 90, right? So you have 10 done. Break even points 10, 20 till 90. Identify quantile values. Quantile function you studied in FRM part 1. Quantile values. Now you identified quantile value that, okay, if you start from here, 1.2816 is the quantile value. Second value is 20%, 0.8416. Similarly, you go here, 80% will be point plus, right? This is minus plus 0.8416. 90% will be your plus 1.2816, right? So you're dividing it. So these are values which are going from negative till positive. And then you calculate the risk measure, weigh each quantile by risk aversion function, average weighted quantiles to obtain your coherent risk measure. Again, you don't have to do this calculation. Whole idea is that you understand it, right? You understand it that this is a method where you are using a risk aversion function. You are dividing each whole distribution into categories. You're not just dividing your tail, right? And first you are dividing the distribution into n minus 1 kind of slices. Then you take the quantiles at each break-even point and you calculate the risk measure. Calculation risk measure is you weigh each quantile, right? Whatever quantile you're getting at the break-even points by risk aversion function. Now there's the calculation of risk aversion function, which is separate, and the average weighted quantiles to then you kind of average it and you take the weighted quantiles to obtain your coherent risk measure. So here in FRM part 2, you are talking about a coherent risk measure. You are not, earlier in FRM part 1, you said very clearly that, okay, expected shortfall is one of the coherent risk measure. Now here you are saying that no, there can be many coherent risk measures. One of them where the weighing is 1 minus 1 upon 1 minus confidence level, that is expected shortfall. That's a special case of coherent risk measure. But we can have more coherent risk measure. And how do we calculate it? We divide the entire distribution, in equal slices. Then we take the your quantiles, we take the weighing, and then we take the risk function. We multiply with that, and then we kind of average it. We get the answer, right? But again, this is not done here. But whole objective is you should understand. Again, this is complex, guys. This is complex. This you are reading for the first time. Okay. Now we don't have that calculation, but we have something else. We have again a coherent risk measure, convergence and standard error. So this is asked in exam, convergence and standard error. So what are the convergence properties? Please understand that when we look at a coherent risk measure, right, more sensitive to choice of your n, right, number of slices than your expected shortfall. The convergence to true value with sufficiently large n. Higher n pushes quantiles into distribution tails where extreme values exist, right? So what we have seen is convergence means how are you getting closer to the actual value? How, convergence, what is the convergence property? Your calculated value, how closer it gets to your actual value. So the whole idea is try to find your optimal n, start with small n, double repeatedly until your estimates kind of stabilize. Doubling your n, right, halves the width of your tail slices, that we understand. Calculate your halving error, difference between your consecutive estimates. optimal n achieved when halving error is equal to 0, right? Again, this is a lot of theory, and I told you my first thing when we were discussing in FRM part 2 was that in FRM part 2 you will find things where things become very complex. So this is the part where things start becoming complex now, because this is here where they are looking at now convergence properties, and they are talking about that, okay, you are getting into a specific kind of things, right? You're talking about you have to increase your sample size, right? You start with a small n, then you double repeatedly. Now when you double repeatedly, the width becomes smaller, you know uh, it becomes half. And then there is something called halving error, right? Halving error is that when you calculate the estimates of anything, you'll always take the difference, right? What is the difference? That's the difference which we had earlier taken, na? See here, when we are done, na, this is the difference we calculate. So we calculate the difference. We want the difference to kind of decrease. We want the difference to kind of decrease with time, not increase. Right? Difference. Optimal n is achieved when halving anything becomes kind of 0. So in this, there is some concept called estimating of standard errors. What is important to understand is it is important to compute the standard error for risk measure estimator to understand their precision, right? The formula for the standard error of the quantile, right? So see, where are we going now? Now we are entering a territory where we are looking at standard error of a quantile. Okay, if you remember your FRM part 1, we had standard error of estimators, right? You remember standard errors. So we had always have standard error of your estimators. What were the standard error of estimators when we used to? So when we used to consider your hypothesis testing, what do we used to do? That when the population is known, then take sigma by root n. When population is not known, you take your standard, sample standard deviation by root n. Remember this part? This used to be in hypothesis testing, na? Yes or no?
Yes. Yes. Yes.
So we used to, right? Why did we calculate the standard error? See, standard error is calculated again and again in different concepts in your quantitative analysis. Why do we do it? Because standard error of anything gives us how much close we are getting into that value, right? So to get the accuracy, to get the precision, right, we have to calculate standard error. This is part of your syllabus, right? Standard error of the quantile function is equal to root of p, which is basically the left tail probability, 1 minus p, right, which you divide by your n, right, full thing, right, and then you take fq is the probability mass, fq is the probability mass, right? Very tricky. And then again, you remember in your FRM part 1, we used to calculate what? Confidence interval. How did we calculate confidence interval? What was the thing? How do we use to confidence interval, guys? Mean value plus minus your what? Z into standard error. Yes or no? That's what we used to know. Mu value we used to take in between, and we used to say na that mu minus Z into your standard error, right? And right, this like that, mu plus Z into your standard error. Am I right? Something like we used to do now for confidence interval,
Yes.
right? Confidence interval we used to do now. So confidence interval. This pen is getting stuck. Same thing here. The confidence interval based on the standard error is given by same thing. Q plus your standard error into your Z, same thing. I written mu na, so they have written what? They have written in the opposite direction. Again, I have written equal to also. So I think equal to is was there or not? Anybody remembers? I don't remember equal to was there or not. Just check if equal to was there or not, guys. I'm not sure. I think equal to was there. But I'll also check the formula. So I have written this formula. They are doing the same thing, and now they have written in a funny way. right? Instead of mu, they have written VaR, right? And then it is the same thing, guys. Mu minus Z sigma. Here it is Q minus your Z into your standard error. I told you standard error is what? Again SE, right? And Q plus Z into your SE. So same formula, same logic. Again, they might have written in a different way, but logic is same. Are you getting my point, everyone? It's the same logic, na? Yes or no, guys?
Yes.
Right? It's same logic, right? So remember the logics, right? I don't think there should be any problem, right? It is just a funny way of writing the same thing, right? This pen is getting stuck now, guys. Sometimes what happens is that you know pen doesn't work properly, so this is creating problem. But okay, let's see in the next slide. Okay, so here Q is the quantile function, that is the critical value, and SEQ is the standard error. That we know, right? We already have studied this thing in FRM part 1, right? Only thing which is coming new here is standard error, that you should know how to calculate, right? You know standard error, confidence interval is very easy. Understand the properties that you are trying to understand, that how can I reduce, how can I make the halving error zero? Halving error zero is you take small n, you continuously double it, the width becomes smaller, 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 halving error becomes quite small, etc. And higher n pushes quantiles into distribution where extreme values exist, and you want a proper estimation, you want n higher. That's what you do. Okay, so moving on. Okay, let's try to understand the calculation again. This will be interesting. Construct a 90% confidence interval, right? Construct construct 90% confidence interval for 5% VaR, the 95% quantile drawn from a standard normal distribution. Assume your bin width is equal to zero point 0.1 and the sample size equal to 500. Again, I don't think there should be any problem with you. See, what has been given to you, bin width is given to you, right? 0.1. If you remember, right, what is the question asking you? Confidence interval. To find confidence interval, right? To find your confidence interval, right? To find confidence interval, we need your SEQ, right? To find confidence interval, we need your SEQ. To find your SEQ, which is standard error, right? What do we need? We have understood the formula: probability of the left tail 1 minus probability into n divided by FQ, right? We have to know. Now, FQ we have to find out, right? We have to calculate FQ, right? FQ, how do I find out FQ, right? FQ was what? What was FQ? Anybody remembers? What was FQ? What was FQ, right? If you have gone here, probability mass, probability mass. Now, how do we calculate the probability mass, right? What's the logic here, right? So let's see this question, okay? The quantile value Q corresponds to 5% VaR, that's fine, which occurs at 1.65 for the standard normal distribution. The confidence interval takes the following form, right? Which is, if I have to calculate your VaR, right? VaR, it is taking what form, right? It is, why they have taken 1.65? Why this 1.65? Why 1.65? Anyone? Why this is 1.65? We have taken the mean value, mean, plus minus your Z sigma or standard deviation, standard error, ZSC, right? And mu plus ZSC, right? These were the two things, na? ZSC, ZSC, right? Why this mu is, tell me why this mu is 1.65? Anyone? Right, this mu is taken 1.65, right? Any idea? Think about it, guys. What can be the logic of taking your this one? Any thoughts? Try it, guys. Try it. That's how we learn, right? See, Z, I understand. If I okay, Z, I understand. Uh, Z is 1.65. I totally get this value. Z for your 90% confidence level, two tail value 1.65. I get it. This is also I get it 1.65. Right. Now the question is that why is when I take your confidence interval, it is mu minus Z standard error. Why the value of mu is 1.65? Z I understand 1.65. Why I am getting your mu, right, or the q, the quantile function q as 1.65? Think about it. Hmm? 90%, 5% VaR. Does it ring a bell? Hmm? Okay, let me write down. See, please note this Z value. This value is coming from what? This Z value is coming from 90% confidence interval. First part. First, this value is coming from 90% confidence interval. Where is this value coming from mu? Where is this value coming from mu? This value is coming from 5% VaR. Right? This value is coming from 5% VaR. 5% VaR means 5% left tail. 5% left tail. What is the value, guys? What is the value, mean value of 5% left tail? In the your what do you quantile function? Any idea?
1.65.
1.65. What is the quantile function? See, if you remember quantile function. Quantile function, if you remember, in your FRM part 1 was inverse of your CDF. So if I take this one, right? If I have to take 5%, right? If I take, or if you take 95 here, and I have to take this part, right? So quantile function is inverse of CDF, right? So it was giving me 1.65. Quantile function is, no, what is that probability value that will give me 95%, right? So for one tail it is 1.65, right? Please understand this, that this mu is coming from 5% VaR, and this is 5% tail value. It is coming for quantile function. Quantile function is inverse of CDF, and quantile function used to give us the what you say, that particular your value at which we have 95%, 95% value, right? So this value is coming. So this value is coming from 5% VaR, right? So both are coming from different places, guys, right? It is just coincidence that it is 1.65, 1.65, but this is how it is, right? So this is the value which builds. Now you will say that okay, fine, 1.65 plus 1.65 SEQ. So I need to find SEQ. Now question comes is, how do I find SEQ, right? That's the next part, right? Your standard error for this quantile function. Now if you see this formula, okay, standard error, okay, how do I calculate it, right? That's the next part which comes to my mind, that what exactly will be the thing. Okay, so since bin width is 0.1, Q is in the range of your Q is in the range of 1.65 plus minus your 0.1 divided by 2. Why? Because width is 0.1. So you're saying left side little bit, right side little bit. 1.7 and 1.6. Note that the left tail probability P is the area to the left of minus 1.6 for a standard normal distribution. Now calculate the probability mass. Uh, Probability mass is required for FQ. Calculate the probability mass between 1.7 and 1.6 represented FQ. From the standard normal table, the probability of a loss greater than 1.7 is 0.045. Similarly, for the probability of loss less than 1.6, right tail is 0.945. FQ you have calculated 0.01. Now your question could be for students, sir, do we have to do all this in exam? No, you don't have to do all this in exam. In FRM, they don't tell you to do all these steps. This is more for your understanding that, okay, if you have to find your probability mass FQ, you have to go and see Z table. But in exam, they don't tell you Z table. They give you value directly, right? So please understand, if I have to find the values, right, you subtract the values to the left of the 1.7, 1.6, and otherwise they might give you probability mass directly also. You put these all values, probability less, the probability of loss greater than 1.7, 0.045 coming from there, right? It is, this 1.7, right? And this 1 minus P is also coming from there, and you have 100, 500. This width is given to you, FQ is given to you. So you please note, this will come from Z table. I'm just giving you idea. This will come from Z table, but how will it come from Z table? You have to incorporate your bin width, right? Then you have to find the values, right? And this also will come from your Z table, right? This also will come from Z table. This is a calculation, and then once you found this 0.9271, and you put the values and you get it, right? So I know this is complex, not easy at all, not easy at all. Why? Because you have to see lot of Z table now. But coming back to your exam, right? Coming back to your exam, will they give you that go see Z table, etc.? No, FRM part 2 doesn't have that much time to waste, right? There are only 80 questions in exam, and there are many important topics to test. So if at all question will come from in exam, they will directly give you FQ directly, right? FRM part 2, that is the beauty. FRM part 2 doesn't waste time in solve this step, that step. FRM part, you check your understanding of formula. They tell you that, okay, you know the formula, get the answer. FRM part 2 numericals are super easy. Numericals are directly dependent on numerical. If you know the formula, if you know this formula, right, what I have written, if you know this formula, and if you know this formula, FRM part 2 is very happy, and it will give you all the marks. They will give you P value also, they will give you N value also, FQ also. You put that and you find out. But yes, they also tell you how to find out, so that takes a lot of time. But please understand that. Okay, so this is tricky. I totally get it. Go back and try it out, try to understand, open your Z table, see this value. If you are not able to find, we'll discuss it tomorrow again. Okay, do that, take it as a homework. Everything is written here, right? Try to find the value of P, 1 minus P only from Z table, and FQ also from Z table, right? Try to do two things. Okay, so this is done. Then we have coherent risk measure, variance approximation. So the point here is that if you want variance approximation, please note that if you are increasing your sample size, right, N increases, right, obviously standard error will go down, right? That we understand, because obviously your N is in denominator. Confidence interval when standard error will go down, confidence interval will narrow. That we also understand. If you increase the bin size, the probability mass function FQ increases, which is your denominator again. Left tail probability P kind of decreases. Remember that. Standard error decreases because again standard errors FQ is in denominator. That we understand, right? So it will go down, right? And the confidence interval narrow because standard error goes down. This will also go down. Estimating or increasing your tail probability, P is increasing, then standard error will actually increase. If standard error will increase, your estimator becomes less precise. confidence interval will widen. Obviously, you will have large values, and that is why we try to understand that the p value, right? P value is maximized at 0.5, right? We try to have maximization at 0.5 for your better calculations, right? Understand these are properties, right? These are properties that you should know, right? They test these things in theory, right? So have an idea about it. Okay, let's do the question, guys. Which of the following statements about expected shortfall estimates and current risk measure are true? Expected shortfall and current risk measure estimate quantiles for the entire loss distribution. Correct or wrong? Tell me, guys.
Wrong.
Is it wrong? Okay. Why wrong?
Coherent is for the entire data,
Right?
and
Yeah.
expected is on the
Expected
tail.
shortfall is only for tail, right? Expected shortfall and current risk measure estimate quantiles for the tail region. No, current is for full, right? This is also wrong. Expected shortfall estimate quantiles for the tail region. Perfect. Current risk measure estimate for the non-tail region only. No, it's wrong. It's for entire. Expected shortfall estimate for the entire distribution, and current risk measure estimate for the tail region only. Now again, this is wrong. So what is right then? What is right?
Expected is only for tail.
Expected is only for tail, na? So you're saying C is right? But what about
Wrong.
this? Coherent risk measure for the non-tail region.
Coherent is for the entire
Yeah.
region.
Okay. Let's see the answer. I doubt what I'm missing. Right. B. Uh, expected shortfall. What are we missing? Expected shortfall estimates quantiles for n minus 1 equal probability masses in the tail region only. That's fine. Current risk measure estimate quantile for the entire distribution, including the tail region. So, what was B? Why did we miss B? We also were saying the same thing, na? B was what? Alpha current measure estimate. No, this B option is written wrong then, right? B is saying something else, no? Answer is saying something else. Yes or no?
Yeah, yes.
Yeah, so the question is wrong, right? This answer not matching with option. I'll get it resolved. I'll tell Pratik. Not matching with B option. Because we were right in our thinking, but all options were not matching, right? Okay, fine. That's okay. So that's it. And then let's take another question. Which of the following statements most likely increases your standard errors and current risk measure test? Sample size. Okay, let's first we talk about increasing sample size. If n increases, right, then will your standard error increase? No, na standard error is in denominator, right? So we want to increase standard error. So it means we have to decrease the sample size. So this too goes away. Now decrease sample size we understand. Now increasing the left tail probability or decreasing the left tail probability? Increasing, right? Because standard error is what? Right? If you standard error is your probability, na? P1 minus P divided by root n divided by root, right? Or FQ, right? So if I have to uh, increase standard errors, I have to increase the probability, right? Yes or no? Increase the
Yes.
left tail probability, right? So the answer is C. So very easy. I don't think there should be any problem here. Okay, so this is C only, right? Yeah, C. Perfect. We have done the same thing. Uh, then your quantile QQ plots, right? Again, QQ plots are very famous plots, right? These are visual representation, right? Visual representation you are used a lot in our understanding, because by seeing the design, the shape in the quantile plot, we can make many what you say understanding becomes very clear, right? We can take out a lot of inferences, right? So what is the purpose and methodology? It's a visual tool to examine if empirical data fits your theoretical distribution, plots your empirical quantiles against your theoretical quantiles at regular confidence intervals, so you get an idea whether the thing is matching with what we thought and what exactly happens, empirical versus theoretical. If there is similar kind of distribution, if data from the same distribution, empirical median plots near zero, right? So that is what, if they are coming from same thing, your empirical median plots are near zero. If you are plotting from multiple quantiles, right, 40, 60, then creates linear QQ plot when distribution closely match. Again, these are plot points we have to remember, right? That if you are plotting from the same thing, right, empirical median plots near zero. If you're plotting from different, they closely match. uh, then we look at t distribution versus normal, which is example, both are symmetric but t distribution has fatter tail, we understand. Near median 50% confidence, quantiles align closely, that's okay, fine. In tails, quantiles diverge. 95% confidence level, here value different, here it is different. 97.5, again it is different. So that's what we realize, right? This is what plotting multiple quantiles create, right, linear QQ plots when distribution closely match. But when we go into higher kind of quantile, right, there is a divergence which happen, right? General interpretation rule, middle matches, which happened here also in 50% confidence, it kind of matches, right? But when we go to tail, there is an empirical distribution is symmetric and non-normal tails are fatter or thinner, right? So overall, the idea is that QQ plot is a very good visual tool where we can check whether our theoretical distribution match the empirical quantiles or empirical distribution or not. If you have data from the same distribution, generally you will see that theoretical median is exactly is equal to zero. If you are taking from multiple quantiles, you create a linear QQ plot where distribution closely match. You generally see that they match in the middle part, but in the thinner tails, etc., they don't match, right? So that's again properties of the QQ plots. Very important visual tool used. Okay, this is what the QQ plot is given below. That QQ plot, you see that we try to plot it in the middle part. You see yourself in the middle part, it is matching. In the middle part, things are matching, right? But when you go higher part or lower part, things are not matching, right? So remember this point, very important. Then next question: the quantile QQ plot is best used for what purpose? Testing an empirical distribution from a theoretical distribution, testing a theoretical distribution from an empirical distribution, identifying an empirical distribution from a theoretical distribution, identify a theoretical distribution from an empirical distribution. What is it, guys? So let's go to definition again. It is testing or it is identifying, right? What is the logic here? Is it testing or identifying, right? Examine if empirical data fits theoretical distribution. Empirical fits theoretical, right? So first part is clear. Empirical fits theoretical, right? Uh, Examine if empirical, what purpose? Testing or identifying? What will be it, guys? Tell me.
Identifying.
Okay, why not testing? Like what can be the reason? Like, oh, see, identifying is also one. Why not testing? And what's the logic here, right? Anybody
I
else
think
think about
because
it?
examination would seem like you're visually trying to just see what's fitting or not. Testing would involve maybe some formula
Okay,
based check or something.
okay, all right. So I'll rephrase. When we are looking at your QQ plot, uh, what is the objective, right? Are we testing it, right? Are we trying to test? Are we trying to get some values? We're trying to test an empirical distribution from a theoretical distribution, etc. Or are our objective is kind of identifying or just checking whether empirical distribution is different from a theoretical distribution, right? Or what is it? It looks like identifying, right? It look like very clearly that okay, we are trying to have identification, we are trying to plot it on the table. It's a visual diagnostic tool, right? It plots it. So it's not a formal hypothesis testing, right? In your finance, You have testing, which is hypothesis testing. It's not a testing. You're not the part. Some noise is coming, guys. So it's not testing. It's not a hypothesis testing going on. And if you go back to your definition now, right? What are we doing in definition? If you look at your definition, it is empirical data fits into theoretical. So empirical fits into theoretical. Theoretical we know, right? So empirical from a theoretical, not a theoretical from a. So C is the answer, right? Most probably it's not a hypothesis testing. So let's see ahead if there is something else. Yeah, that's what we have, right? So once a sample is obtained, it is created, right? It's not a hypothesis testing. It is compared to a reference distribution for possible identification. The QQ plot maps the quantiles one to one. The relationship is close to linear. Then a match for the empirical distribution is found, right? QQ plot is used for visual inspection. Okay. So easy chapter, guys. I think in this whole chapter, one thing which is difficult, right? One thing which is difficult is your, one thing which is difficult in this chapter is your this here, right? Calculation of your confidence interval, that one part, and maybe remembering this part. But this is also formula. This is also easy. I'll not count it difficult. Just remember it. I'll say this is remember it. This is more of a remembering kind of stuff. Remember it. So this is one part, right? But if there is any difficulty in this chapter, right, which can create little bit of confusion, is this part, right? But again, I'm telling you, like, if you think about that, this question will come in exam. If this question will come in exam, you will be given FQ directly, P directly, everything directly, right? Nobody has time in FRM part 2 that they will tell you go to Z table, find the value. That is FRM 1 style, right? That is not FRM part 2 style. FRM part 2, these things don't happen, that you go to Z table and all that kind of work you will not see here. So you learn it, you learn how it is done, but be very clear that 99.99% you will not go to Z table and find values. You will be given values of FQ, P, N, and you will be asked directly calculate the confidence interval and the standard error, right? So you just need to know the formula, right? Otherwise, this chapter is super easy, right? We have completed this chapter today, right? Anybody any doubt can ask me. Else, I think this was easy one, right? Anyone any doubt? Were you able to
Not
understand?
really. Yes.
Yeah, able to understand, right? Fine. Okay with the speed and everything, all good?
Yes,
Yes. Yes. Yes.
Great. Okay, we are on time, guys. Let's meet tomorrow and do the next chapter, okay? All right, guys. Thank you.
thank you.
Thank you.
Thank you.